Hi, I'm Greg Hunter. Welcome to USAWatchdog.com. We have back with us once again one of our favorites, one of my favorites, Jim Willie, Dr. Jim Willie. He holds a Ph.D. in statistics from Carnegie Mellon University. He is also editor of the Hat Trick Letter that can be found on goldenjackass.com. Dr. Jim Willie, thank you for joining us today.
Oh, good to be back on. Isn't it nice to be back when things are so calm?
Well, after what happened with the Fed Reserve last week with Ben Bernanke and his, we're going to slow the money printing down. We're going to taper maybe at the end of the year if the economy gets better. He knows it's not. And then this week, we have all the Fed presidents and governors, including the president of the New York Fed, who is uberly powerful, just underneath Ben Bernanke out. Oh, no. The markets misunderstood Bernanke. They got it wrong. What is your take on this announcement by Fed Chief Ben Bernanke that they're going to, stop the money printing, which is propping up the economy, and then everybody else at the Fed coming out this week and going, no, that's not what he meant?
Well, I'd be a liar if I said I had all the answers, but I've got a lot of thoughts, and really this is a time for speculating as to what on earth is going on here with Treasury bonds. And I've got a number of opinions. I think it's really difficult to know for sure. But here are a few scenarios. I thought immediately the Fed was doing a live stress test to see what's going to happen, what will the damage be if they allow interest rates to rise in that scenario. Or else the Fed is pretending to do a test, but instead they're just floating a trial balloon to see what kind of a psychological reaction there would be, because a lot of really intelligent corners of the world know that much of the U.S. is being propped on five stools. I'm talking about stocks, bonds, the dollar, housing, the economy. And they're all supplied by the Fed. Take that away and everything falls. All the legs of the stool are gone, and there's no leg of the stool left. Even worse than that is a possible scenario where the Fed is faking a live stress test in the midst of a gigantic global U.S. Treasury bond dumping exercise that I highlighted a month ago with all the different channels, like the foreigners redeeming their Treasury bonds, the foreigners converting into gold, even the U.S. banks unwinding their carry trade. You just got so many things going on here. But any stress test, I believe, is going to be centered, the damage that is, the effect, is going to be centered on the interest rate swaps, the derivatives. They're almost like bait. They're the most vulnerable. It's like you've got a total Politburo dependence. And then you've got these flying buttresses that are creating artificial demand for the Treasury bonds and making sure, if there are no buyers and there's tremendous amount of supply, why are interest rates so darn low? It's because they've got artificial demand. The Fed knows they have no exit. The Fed's frustrated. They got an alternative. Continue what you're doing or collapse the entire system. Everything is dependent on the Fed's support. They know that if they take it away, they're going to create a black hole, since the Treasury bond right now is the greatest asset bubble in history, twice as large as the housing and mortgage bond bubble, maybe 3 or 4 times as large. They've been acting as sugar daddy with spiking the punch bowl. They can't take it away. They can't. They're piling up toxic garbage. They're the buyer of last resort. People just don't even think about, what does that mean? It means the Fed is accumulating $3 trillion worth of rubbish. They buy the worst quality. So if they don't buy it up, who's going to buy the worst quality of these bonds? I think the Fed balance sheet is going to expand further, not contract. I think they're liars. I make a living off proving that they're liars. I make a living off proving my assumptions. Initially, they're liars. They've been liars for everything they do. Green shoots, exit strategy, big global Treasury bond rally, flight to safety. Everything's a lie.
I want to interject right there, and I just want to say this. You're not the only one that says that. Jim Rogers comes on and unabashedly says, hey, you have Ben Bernanke all the time. If I came on and every time I talked I was wrong, would you have me back? And so, I mean, you are not alone in that. And he's a big-time investor. But I digress. Go ahead.
I agree with you completely. And that's one of the breakdown points of the mainstream press. They keep having back the clowns. Like there's a guy named Brown who's on Bloomberg and CNBC a lot, and he's just wrong about the big banks every single time. It's like he's their, assigned spokesman. The stocks are under the dependent spell. They got the Working Group for Financial Markets, aka Plunge Protection Team. But now a new thing with housing that's giving wrong signals is you've got private equity firms. These are Wall Street funds and hedge funds and all kinds of different organizations. They're pursuing about 5 cities right now, and they're prompting a little bit of a housing price recovery. I call it the feudal mezzanine because they're buying thousands of bank-owned mortgage foreclosure properties. All right. The live stress test, I believe, is a wrecking ball, and they better be careful because it might develop a mind of its own and momentum of its own. This is really, Greg, I hate to say it, but this is Reich finance, as in National Socialist, as in Nazi. This is Reich finance. It's this Politburo Soviet parallel. The foreigners are demanding an end. They're seeing exported inflation across the world. Their cost structure's higher. It's so bad that mining companies have laborers who can't afford the increase of the cost of their own living for surviving. So they're doing strikes. And that's one reason I absolutely hate mining company stocks. They're a loser's game. So the Fed realizes if they continue where they're going, they're going to be exporting inflation and causing a 0% conclusion to the Treasury bonds, which will suck in all the capital and cause a U.S.-based black hole of darkness. But they can't interrupt it either because it starts the process of unwinding and pricking the bubble. So I think there's a big handover going on. There's something else happening that you got to address a little bit. The Fed's contract is up in just a couple months. And I've got some stories from very bright and informed friends that they handed over their balance sheet. They handed over their books to the U.S. Department of Treasury last month. It's a developing story. The Auditor General has already determined that there's $9 trillion missing. And that's the size of one of the most recent just projects of largesse to the other big banks around the world. I have a joke. The Fed's going to print $20, $30 trillion, and they're going to try to buy up the world after they drive down the prices. The Fed's stuck. They know the gigantic props cannot be removed. They know there's no exit strategy. They know there's no exit route from their concluded contract. I warned back in 2008, one of the possible end scenarios for the Fed is they just resign. They're coming to the end of their contract. They just resign. And what happens to their garbage dump site of balance sheet?
The U.S. will just have
to the U.S. government. And it helps to kill the dollar. It's $3.5 trillion, Greg. It's the worst quality. So foreigners are demanding something. I think they're selling in tremendous volume behind the scenes, and it's going to result, I think, in the Fed increasing their soaking up of the Treasury bond supply. They're not going to taper off. They're going to increase while they talk about tapering off, and it'll be more Reich finance. People really need to understand this is the same bunch, their grandchildren, as 70 years ago. They're Nazis. The U.S. is exporting price inflation. It's their usual trick. The foreigners are saying, we have enough of this. We're going to continue with our own plans. The G20 is extremely important right now, and it got interrupted in May in Ankara, Turkey. It's not going to be interrupted in September rather. September is a very important G20 coming, end of the summer, in Moscow. It will not be crashed by the G7 minister monkey clowns. The G7 will not crash Moscow. They won't be allowed into the airport. So I think the Fed has misjudged a staggering number of channels for selling, and the proximal victim here, I believe, will be Japan. They have just a disaster unfolding. It's not just that they've got a big commitment to quantitative easing, chapter 238 since 1990, but they gave up a good deal of their manufacturing to China for cheaper labor. And now they've lost their trade surplus, which they used to help keep down the yen. And now they're having problems. This is just a mess. Japan is a total mess. So this taper talk, I believe, is political cover. And, you got to take another look also at the Basel III rules for tighter derivative trading guidelines, interrupt the proprietary trading in-house, put up greater collateral for your asset base. It's a prescription to collapse the system. But I don't want to get into any discussion here in this venue for the great Western fascist plan for global rule. I don't want to get into that at all. So, there's a braking mechanism that my friend Rob Kirby pointed out. He said that there's a false flag of sorts that's going on, and it's focused on the failures to deliver. And Zero Hedge is focused a good deal on this. It's a tremendous journal site. A lot of things you can't find anywhere else except Zero Hedge. But they might have misinterpreted this failures to deliver, because the Fed uses IRS supply as a braking mechanism. They use the Internal Revenue Service. They use the tax system because that's often where the income arrives through the tax avenues, the withholding income for payrolls and all that. The Fed is going to apply the brakes and prevent this interest rate rise from going up too much, just by working their IRS tax angle. Now, some people think, well, gee, this is really a lot of different agencies and institutions and firms and individuals who are trying to short the bond market, bringing about a failure to deliver the bond. But that's probably not the case. It's made to look like a shortage of treasury bonds because there's so much demand for these wonderful AAA U.S. government debt securities. Pardon me. There's a lot going on, and the IRS is an angle. I think you need to watch the interest rate swaps, the derivatives. Remember, a year ago now, we were talking about the London whale and the great lies that were told by J.P. Morgan, which is the right-hand man for the Federal Reserve itself. They talked about how the London whale lost a bunch of money with sovereign bonds from Southern Europe. Liar! Liar! It was about interest rate swaps because the interest rates had moved so much. They had moved about 30, 40 basis points. Well, now they've moved 70 basis points. So imagine high winds hitting a 200-story tower. That's the effect of changing interest rates. Doesn't matter if they're improving or worsening, going up or going down. Doesn't matter. The effect of moving interest rates is devastating to interest rate swap derivatives. Look for a new London whale to emerge in the next several weeks. It's going to be a big victim. I think the G20 is critical, because in Ankara, Turkey, in May, they were going to have a big bunch of tables for nuts and bolts on gold trade settlement. And don't believe for a minute that the BRICS Development Fund is all about building railroads in Tanzania and other locations in Africa. It is going to be, this BRICS Development Fund is going to be a giant treasury bond processing plant converting emerging market surplus treasury bonds into gold bars. The BRICS Development Fund, I got news for you, it's the gold trade central bank that bypasses the dollar.
Well, I'm glad you brought that up. Let's get into these failures to deliver, possibly. Eric Sprott was talking about this when I had him on, saying somebody's going to fail. COMEX, LBMA, there's somebody going to fail, and you have some major thoughts on the mechanisms that could be applied to basically cause a failure at COMEX. Tell me about that, and what happens when they fail? Does the price skyrocket? And what's going on with the price of gold? I know I'm giving you a bunch of questions at one time, but what's going on with the price of gold? It's just being hammered down, and do they really? What happens when they run out of gold to deliver?
Well, first of all, you got to realize, and the listeners have to realize, COMEX does not set the price of gold. COMEX has a billboard with a number on it and the word GOLD next to it. That's not the price of gold. You don't dictate the price of gold. You don't target the price of gold. It is not the equilibrium point at which supply meets demand, because there's inadequate supply and there's gigantic extra surplus demand. There's no supply, there's surplus demand. That's not the price. Go to your basic economics courses where freshmen in college learn that price is where the equilibrium is reached of supply and demand. That is not what the COMEX does. There's a powerful force going on right now, and it's in Shanghai. The Shanghai gold price is $20, $30, $40 higher than U.S. and London. Well, why is that? Because the U.S. and London price is not the price of gold. It's a marquee billboard with a number on it with the word gold next to it. It's not a price. It's the crappy price. It's the crappy amount of money they will give you if you're stupid enough to sell your gold bars.
So people should not be sellers in this market. You are predicting at some point it ricochets back up. Is that correct?
Yes, the real gold price, not the COMEX price. In order for the real gold price to reflect true value, we must shut down the COMEX. And don't worry, they're helping themselves to shut it down. They're doing it all by themselves by keeping the price down. They're causing a fire sale around the world. But let's just focus on Shanghai for a second here, for a minute or two. This is very important. Let's just call it a $30 premium in Shanghai. Okay, well, notice that on May 31st, there were 15.5 tons sold in the cash gold contract in Shanghai on a single day. Now that's versus 10 tons 4 days before, a 50% rise in 4 days. Arbitrage is presented where you can buy in New York and London, take your delivery, and sell it in Shanghai and earn a $30 profit. It represents yet another drain from the Anglo gold vaults, in addition to what I was describing a year ago, where they were forcing on margin calls, mostly the Chinese different institutions were draining London gold because of some improper usage of very old family Chinese gold, and they didn't like it one bit. So you got logistics involved for shipping and, ownership transfers, but, sometimes you wouldn't even need to ship the gold. You just have your Chinese guy living in London. So he accepts it in London and he sells it in Shanghai, except that they accept it for the Shanghai purchase. They accept it in London. And there's lots of logistic complications here. But there's something else very important going on regarding the killing of COMEX by their own people, and that is that the Wall Street firms and the hedge funds are draining the GLD fund, the SPDR Gold Trust, the GLD fund, the exchange-traded fund. That's for the lazy-ass, nitwit, stupid stock investors who think they're buying gold, but all they're really doing is putting up their money and making sure that gold in transit is gobbled up by the big banks so they can sell it. These GLD stupid investors don't own any gold. Evidence of something very phenomenal is amazing. There's a negative correlation between GLD inventory flow, meaning its outflow, versus the Shanghai rising premium. For the last 3 years or so, it's a minus 50% correlation, minus 53. If you just look at the last year and a half, 18 months, it's about a minus 80% correlation, which means the GLD has bars flowing out the door and the Shanghai premium is rising. And there are other little indications that, like JP Morgan's gold inventory figures are rising. Almost exactly what the GLD bar count is dropping. So Wall Street is stealing the GLD gold, and the inventory is now under 1,000 tons. It's way down the last few months. It used to be 1,200, 1,300 tons. Now it's under 1,000. It matches the JP Morgan increases. It matches the Shanghai premium in gold price. So this extremely rapid decline in JP Morgan Gold Vault inventory volume is important because at the same time, the eligible clients, like best friends of JP Morgan who keep their gold in the JP Morgan vaults, they're getting it out. They don't trust JP Morgan anymore. They see the thefts. They see the rehypothecation. You got to love these vocabulary. There's a new thing came out today. Henry Bath, which is, I believe, a storage vault site operator for JP Morgan, just delisted 21 storage sites worldwide. I'm talking about all over Europe and a couple in Asia. So the JP Morgan gang is abandoning JP Morgan. So this is a grand Asian pull.
Well, wait a minute, Jim. A grand Asian pull. In other words, all the money is going from the West to the East in terms of gold. I should say all the gold is going, well, gold is money, going from the West to the East. When is this drawdown? When is COMEX going to be not going to be able to deliver or will not deliver? When are they going to say, we want to keep the rest of our gold? I can't imagine they're going to let the last bar of their gold walk out of their vaults and have nothing.
Well, these are the big questions, and guys like Eric Sprott might be in a better position to say, and I have a joke. I say it's going to be August 45th. Oh, but there aren't 45 days in August. And I said, yeah, and I don't know the answer to your question. I mean, I don't know. We had a dumb kid across the street in a large, stupid family, and we used to just say, David, how high is up? We don't know. We just don't know. There's a big Asian pull, and I like your little Freudian slip. There's a lot of money moving from the West to the East, and it's in the form of gold. And now it's different from 10, 15, 20 years ago when there was a lot of paper debt securities going from the West to the East. China accumulated a lot of toxic bonds. That's not money. That's debt. People need to understand. Debt is not money. Treasury bonds are not money. Treasury bonds are not wealth. They're debt. They're debt. So there's something else that's going to break the COMEX, and it's a powerful internal force. I talked about how Asian arbitrage and being supplied by the GLD inventory will help to drain the COMEX. If it weren't for GLD, I think the COMEX would have defaulted already. That's how important GLD supply is. But the other powerful force is going to show itself in the COMEX, in the price structure. It's the spread. They call it backwardation, and it confuses a lot of people, but it just means that there's a spread in the future price. It means that the future price, like December gold, is below the current spot price. It's not quite the case now, but it's coming. And it's coming. The logistics managers say that the carry cost is going negative. Why do you have future gold like 6 months and 3 months forward? Why does it cost more? Why is the price of that contract a little higher? Well, because there's carrying cost. There's cost to insure. There's cost to store in a vault. All right, when that goes negative, the backwardation factor will kill the COMEX. It'll be bloodletting, because what people will do is they will buy the future gold and they will sell it at the spot for a profit. And meanwhile, that won't stop the future price from going down. Why would they do that? Well, because there's a shortage of current, present spot price gold. It must meet the present demand. They must avert the shortage and default. Well, what did they do in April to avert a shortage and default? They had a big price ambush. That's why we're having these price ambushes, but they're not really price. It's the marquee number with the word gold next to it on the big billboard for the COMEX. They didn't want in the COMEX in April to declare a default.
So when is this price decline going to be wrapped up? What's the timing? And when will gold start, going back up? What's going to be the trigger that's going to reverse this pummeling that gold is and silver have both gotten? And that'll be our last question.
I think it's going to be the failure of a big bank. It's going to cause the failure of another 2 or 3 other big banks. It might be a default for gold delivery that's widely publicized at the same time that a big bank fails. And I'm hearing that there are 3 banks involved on the short list that every single night are running the risk of having a bank failure, and every single night extraordinary measures are being done to prevent it. Those big banks are Deutsche Bank in Germany, Barclays in London, and Citigroup in New York.
Wow.
All three are in the danger zone of dying just like Lehman. And I got guarantee for you, if we have another repeat like this of Lehman, it's going to be 10 times larger. It's not going to be containable. And I think that's going to kill the COMEX. You know, I use the word kill, but what does that mean? I just mean that they stop selling and trading gold and silver contracts because they don't have any.
It'll be if you want to sell 500 ounces of gold or 5 million ounces of gold, let's see it. Bring it in. There's no paper.
They use the term cash and carry market. It'll be a cash-only market. I mean, it'd be kind of like what you have in India. They banned leveraged loan sales of gold. It's just cash only. Well, that's the way the COMEX should be because they've corrupted the whole leverage process. You know, we got just a couple of quick points here in closing. The total number of ounces sold in coins by the U.S. Mint and the Royal Canadian Mint in 2012, if you extrapolate it to 2013 and consider the mining output for those two important countries in North America, just the coins alone are 25 million ounces more in silver than the two countries produce in mines. And I got news for you. 2013 is going to be lower for production of mine output. So all the industrial demand for North America, excluding Mexico, all industrial demand will be part of an additional deficit above and beyond the 25 million ounces. Now, we're going to silver above 100, and I don't have a great answer for when, but I do know this. The time between events is getting shorter, and every time there's some big events, there's more internal damage. And you know, in April, these bankers slit their throats on stage, and the gold community is not celebrating. I don't think the gold community is all that intelligent. Sorry. We should be celebrating these price ambushes. The problem is that some people need to sell. I got a good friend who's going to law school now, and he said, Jim, I'm a mess. I got to sell a couple coins every month. I hate it. I'm going to be out in 2 years before I'm done in law school. Bad plan. We should celebrate and look forward to the next big ambush because every ambush puts us closer to the COMEX shutdown. That's what you need to release the price of gold. It's coming. It's coming. My gosh, you've got 108% increase in the first 4 months of this year in China for Hong Kong gold imports. 108%. That's double. In Turkey, the gold demand is triple from a year ago. In India, in just the second quarter, they're expecting to import 250 tons of gold. That's double a year ago. So, you know, that accounts for 40% of their entire national trade deficit. I don't care what new rules India imposes. No one's going to stop the Indians from buying gold or having weddings any more than the Federal Reserve would stop Americans from watching football. So it's coming. I love these ambushes because it reveals that the COMEX does not set the gold price. That's not a price.
Dr. Jim Willie, he is the editor of the Hat Trick Letter. You can find it on goldenjackass.com. Always enlightening. I love it that you say we love the ambush. We're getting closer and closer to the beginning of real prices for gold and silver. Thank you very much for being on USAWatchdog.com.
It's my pleasure, and the part of the world that's going to determine the new price is the East, led by China and Russia, and their gold trade settlement, and they're talking about 7,000 gold and at least 150 silver.
And with that, we will wrap up the interview. Thank you very much, sir.
My pleasure. Thanks a lot.